Niel Hiscox with Canadian Auto Dealer. Today, talking with Cliff Banks, one of the leading auto industry analysts, particularly from a retail perspective in the US. And I thought Cliff could join us and share some of his thoughts on what the picture looks like south of the border. Cliff, welcome to Canadian Auto Dealer.
Niel, it's great to be with you. Thanks for having me.
Yeah, it's good to talk to you again. You were
Yeah,
last up where you and I had a chance to talk for this
right.
CADA Summit a few years back. We're in a very, very different situation right now.
Much. Yeah, I guess it was about a year ago, last year. Yeah.
Yeah.
So very different.
So give me your sense on what some of the key thoughts, the key thrusts that you've got top of mind as you look at the picture south of the border.
Right. I think short term, getting getting dealerships back in the open mode. Just yesterday, finally, the Pennsylvania Governor Tom Wolf opened the sales up to car dealers from an internet or online perspective. I mean, up till now, they weren't even allowed to sell cars online. And we had the same in Los Angeles and a couple of other states. And it was posing a real problem for those dealers. I think LA opened up yesterday and Pennsylvania did too. So that's a good thing. But again, I think as of now, we still have more than half the states that are only in internet mode. So the showrooms aren't open. I assume you guys are dealing with same same scenario. So working through when states will begin to reopen. Up here or down here, we don't have any set strategy. I think other than letting the states determine for themselves, which depending on your perspective, is probably not a bad thing because we have such a wide variety in terms of cities and population and impact of the virus.
Yeah, you've got some parts of the country, obviously, that have been incredible hotspots. You've got some parts of the country that are relatively unaffected, though you certainly have cases in all 50
Right,
states.
right.
And that creates a tug of war, doesn't it?
It does. I mean, when we look at the sales data coming from each state, you can see, you can before looking at it, you can predict which states are going to be way down with sales. Obviously, New York, Pennsylvania, Michigan, and some others, California. Others are doing much better than we expected. Texas is, I think, the last data I looked at, and I'm not exact sales data, but actually credit apps that were flowing through that had been submitted. Texas was down less than 20%. We have some states that even were the same as last year. And there's some dealers up in the Northwest, North Dakota, Idaho, Montana area, dealer groups that are saying they're ahead of last year with sales. So I think certainly the different areas of the country are going to be impacted differently. But some of that data poses or presents a reason for optimism too, because if we start opening it up to more dealers, more states, maybe sales won't be as bad as we were projecting. I think the number was first 2 weeks of April, Neil, down here was sales were off by 45%. We were projecting probably it being down 80 to 90%. And that's new car sales. I think used car sales are going to be a whole different issue. They're going to be another just a problem that we're going to be dealing with for at least 6 months is the inventory levels of used cars and the subsequent hit on valuations. That's going to be a big problem.
Talk a bit more about that.
Well, we have the scenario now where I think most dealers and banks or lenders that hold the paper on the leases and the rental companies are looking to sell or reduce their inventory levels significantly. The problem is the people that are looking to offload their inventory are the same people that need to be buying the inventory are the normal buyers. So we just don't have any buyers. It's a real problem. I mean, a rental company like Hertz, because of its debt load, they could be forced into bankruptcy sometime in June. I think we'll see. It'll be interesting to see what the impact is on a CarMax and a Carvana, and even some of the even some of the financial lenders like Ally and others, Bank of America, and then certainly the captives, the domestic captives, I think are probably really nervous right now, because if we see that huge hit on valuations, used vehicle valuations, then there's going to be a lot of companies losing a lot of money. And right now the valuations are down 10, 12%. And we'll see if that continues the rest of this month. If that does and continues into May, then yeah, there's going to be some carnage.
Yeah, well, a couple of things that I've read a lot about certainly is the risk of what you could, there's a lot of conversation around, does this look like a V or a U from a recovery standpoint? But what I've read in a number of instances, the thing everybody should fear most is a W, where we open back up too soon. Companies that have been sitting on some cash.
Sure.
Use that to open back up. We see a resurgence of the virus, and now we have to shut back down again, and everybody is in a weaker position for that second restart.
Yes. Yeah. And even if there's not a resurgence of the virus, I still think we're going to see more of a, and I'm going off history here, I'm going off 09. We saw a little bit of a quick uptick in 09, late 09, partially because of cash for clunkers and aggressive incentives. But then we settled back down in 2010 and kind of began that slow recovery back to 15, 16 million, which we didn't hit until 2015. So it was really a 5-year process before we were back up, to levels that we were prior to the Great Recession. And chances are, it may play out like that here. Again, I think the unknown, Neil, is what happens with the virus. We're dealing with something that we've never seen before, and and how to project, how to create forecasts, or how to plan. You got to plan for different eventualities, I guess. Yeah, talking to some dealers last week, and the word recession came up, and he practically jumped out of his chair and said, "Look, bring on the recession. I'm all for it." He said, "We know how to operate in a recession. This is virus that we don't know. We've never seen. We have no clue with." He said, "I'm fine with it. I'm fine with a recession." So I think that mindset is prevalent in the industry.
Yeah, and certainly, from an OEM standpoint, when you start to talk about trying to project different scenarios and then provide inventory for that, you don't just sort of fire up or fire down car plants. Talk a little bit about the OEM side of this and what some of their looking forward must be feeling like.
Yeah, well, going in before we started shutting down the plants, I think we had an average across the board 69-day supply on the ground. And so they probably have a little bit of wiggle room in terms of when they can open up the plants or should open up the plants, because much of that inventory is still sitting there. But they do have to get those plants fired up. Again, we're seeing in Europe now that they're starting. I like what Volvo's been thinking through in terms of how to do it safely. Everyone is, but they were starting to feel the pressure, and they've been very open about that. I think we'll see in Europe, is there, early on, will we see a resurgence within the plants themselves? Here in the U.S., we've had several people die, factory workers, or die after contracting the virus. So, you have that whole issue of safety. It's a balancing act, but it takes time. And I think some of these plants, GM and Ford specifically, are going to have to reconstitute the plants from making medical supplies to going back to cars. You have the issue of suppliers. Many of the suppliers that might be down for the count because of the virus, how to bring them back on or find other suppliers. There's no easy path. Right now, I'm not saying it's undoable. Obviously, we'll figure it out. And I think the auto industry has through the century, going back 100 years, they've been challenged and have figured it out. And I expect the same here. But but I'll tell you, Neil, look, across globally, there's going to be a lot of pain still. And there's going to be some mistakes made, uh, because we've never really had to play with this playbook or play on this field before. So, and I think the ones that the other aspect is, I think, looking at the capital and how well capitalized some of these automakers are. Nissan is one that I think creates, that there's a lot of concern. I said that last year at the Canadian Auto Dealers Conference. I was asked which brands I liked and didn't like, and I mentioned that Nissan was one that scared me, concerned me, as was Jaguar. We'll see where those are a year from now. It'll be, I think, 5 years from now, it will be interesting to see what the landscape looks like from a manufacturing perspective. See if this forces some partnerships or acquisitions that we might not have seen otherwise.
Those who are well capitalized,
yes,
have a huge advantage in this.
Yes,
that applies at the dealer group level as well. Talk a bit about the dealer groups.
Yeah, that's a great question. Deals. Well, one was publicized, Asbury's acquisition of Park Place in Texas that didn't get across the finish line because of this. There was another one that it was in Texas also that was close and was called off. There's been a couple small ones that have happened in the last couple of weeks, but for the most part, activity is dead right now. One, you can't put a valuation on these stores because you don't know how to forecast. We just don't know what the forecast looks like. However, I do believe that within the next 2 to 3 months, if things are in the similar state they are today, Neil, we've got a lot of dealers who are going to become really probably will be on the brink from a cash perspective, and maybe looking for a quick exit. So I would imagine in the next several months, prices will come down significantly. We may see some of the buyers, companies that have sat on the sidelines the last few years and not bought or not gone heavy into acquisition, jumping into the market, because I think there may be some plays out there that are attractive. So I think it's a matter of timing. Does it start happening third quarter, fourth quarter this year, or first quarter next year? Remains to be seen. I would imagine we'll start seeing some activity third quarter, picking up in the fourth quarter, and next year being pretty busy on the acquisition front.
Yeah, I mean, if you've kept your powder dry over the last few years,
yes,
you've got some still as we come through this.
Yes, right. I mean, you look at Lithia. Typically they've been a heavy buyer. They've probably been the most aggressive buyer in the market here, and I would imagine they're going to continue being aggressive. And they've got their list, and they're probably working or engaged in those conversations as we speak.
Let's talk a little bit about, you mentioned cash for clunkers, and I know that that's something that the National Dealer Association up here and some of the provincial associations are pushing for as well. Let's talk a little bit about your ideal view of a government role in terms of programs. I mean, obviously there's been a bunch of small business support that's been initiated and
right.
support, but let's look over the next 6 months. Very mindful of the fact that you guys have an election in that period. But what's your thought on some of the really important things the government needs to do as we start to open back up from a program standpoint?
Well, I think if you had asked me last week, I would have said, and I did say multiple times over the last month, that I thought a cash for clunkers type program, even much more comprehensive than what we saw in 2009, was an inevitable play here by the third, fourth quarter. Today, I don't think that's the case. I think I would be surprised to see one happen. Reason being, we're doing another nearly $500 billion aid package this week. Senate approved it, voted on it last night. I think it'll probably be done by the end of the week. I think we're seeing even McConnell, our Senate Majority Leader, this morning mentioned that he thinks we need to put the brakes on any more aid packages just because of the huge debt that the U.S. has been increasing. Now, others are pushing back and saying, look, we'll take care of the debt later. The money's real cheap right now. Let's get after it. Let's go even bigger on aid packages. But I think that $500 billion is going to impact potential auto-specific programs in the future. I think also there's so many industries here that are in trouble. It was unlike 0809 when it was really automotive. That was it. Other than that, other industries were fine. I mean, the banking industry needed help, but that was a credit issue, and that's what created the problem for the automakers and dealers. Now we have every industry imaginable is being hammered. Airlines, tourism, restaurants, and it's hard to argue one is more important than the other. I would imagine that we will see aggressive incentives from the OEMs over the next 6 months. And I think once the states start opening up and the showrooms become open, we're going to see the incentives ratcheted up because they're going to try and bring these people into the stores. That alone, and plus the fact that we have 4 million off-lease units coming back this year, slated to come back, that's going to create some activity. So I don't know that the auto industry is going to need that cash for clunkers type play. I think if there is one, it would look a lot different. But Neil, I don't know. I'm thinking through this out loud right now, but I would be surprised now at this junction, a cash for clunkers this year.
Well, I think you do raise a really important point, which is arguably there are other verticals, other industries that have been harder hit, and that frankly have an even longer path to recovery. When you think about
right,
the airlines and international travel, and the fact that you literally need to have global cooperation as you start to open that back up again, that could have a very slow build.
Yes. Yeah. And the world does look a lot different from a banking perspective today than what it did in 08, 09. I mean, GM and Chrysler their credit companies, their finance companies were controlled by a private equity, by a hedge fund, Cerberus Capital. And coincidentally, those were the only two companies that declared bankruptcy. And the reason being is they couldn't sell cars because they couldn't finance. They weren't able to finance any of the sales. And once that happened, that's what pushed them into bankruptcy. So today we don't have that situation. And there still is quite a bit of liquidity at the automaker. Well, and I say quite a bit, I mean, within reason. Certainly Ford and GM and could be within, third quarter, could be, if we're where we are today, then I think there's going to be some much tougher conversations. But again, sales aren't being hit as hard as we thought they were going to be, and that's with showrooms not being open. So once we open the showrooms and we start getting some of these off-lease vehicles coming back, we may be able to weather some of the storm as an auto industry. So,
well, certainly there's technology driving, a better and more complete online purchase experience, and I think there's going to be some some legislation change around that has been, part of the hindrance.
So tell me about that. When you talk about legislation, what do you specifically? What are you thinking?
Well, the one thing, one phrase I hear, I don't think I'd ever heard until 4 or 5 weeks ago, and you hear it talked about a lot, is the phrase "a wet signature." That
Okay,
there
right,
you still need this at some
right.
point a face-to-face signature, and there's technologies to allow a digital signature. You need the banks and all to accept it.
That is true. It is funny because I've talked to the Route One guys quite a bit, and even DealerTrack, and we've been having the same conversation about e-contracting for nearly 20 years in this country. Yeah, so some of the states will have to change maybe change their regulations on that. That's a good point, Neil. I think one of the other things that we need to see happen, probably both in Canada and in the U.S., is more of a platform type strategy that allows for an API, a fully open API strategy. I mean, FCA here is launching on May 1st, their online retail experience ORE program, and they've limited the dealers to very few vendors. And I think that's going to limit the overall capability of the program. I think we need to see a much more open play here in the States. And I think as we move forward, we may see a small delay in some of that, but I think as we move forward, we're going to see more of a focus on that platform type strategy. Because I think we need that. Because again, in the U.S., and I think you guys deal with the same thing in Canada, right now it's a walled garden, so to speak, with the DMS players, and I think and it's not just them. I mean, the OEMs have their own plays, and everyone has their own way of reading the data and presenting the data. So we've been working our way through some of that stuff over the last several years, but we still have a ways to go, and I think that's going to impact how fast we can really move into digital retailing. The technology's there; it's getting better, but we need to have a much more open strategy.
Yeah, well, necessity is the mother of invention. So if anything,
True.
you're right.
Yeah.
I mean, I think some of the conversations have been the same for years.
Yeah.
Wondering what is it that's going to make this happen? Maybe this is what finally makes it happen.
Right. My guess is, and I've been saying this for a while, is that really the connected vehicle is going to drive a lot of this, and obviously that's we're not going to see that in force until 2023, as more automakers bring their vehicles online and have the connected vehicles hitting the marketplace. But I think that's what is going to drive much of this, frankly, because it's going to take the focus off of the DMS vendor or the data play and putting it onto the vehicle. I think the vehicle is going to become the gateway that where all the data is going to flow through, because that's the data is going to be in the vehicle.
Well, I had a conversation yesterday with James Carter, who's
yes,
James.
Well, we engaged on LinkedIn quite a bit.
Yeah, and he made the comment in our discussion that there are trends and that have been in place for a number of years now that he thinks fundamentally this is going to accelerate. It's really not going to derail them. If anything, it's going to shove us further down the path. Certainly on the connected. And also on the electric.
Yeah, I'm not as convinced on the electric though, Neil. One reason being, an automaker that needs cash is going to have to make some hard calls as to whether they're going to put their money into the products that are sure sellers, your F-150s, your SUVs, the Rams, the Silverados, or are you going to continue putting that money, development costs, into the investment into an electric vehicle. And I think that for the short term, I think it is going to impact some of that EV investment personally. I mean, because the OEMs are going to have to go with what they know is going to sell. And the other issue is just the oil.
Yeah.
You know, I mean, how long are we going to be seeing these really cheap gas prices right now?
Yeah, I have to say it was an eye opener the other day to see a negative price for a barrel of oil.
We may see that for a while yet. I mean, I think there's some states, Alabama, I think Oklahoma, a couple of other states, we're seeing gas prices that were as low as 69, 70 cents a gallon, which is just unreal.
I keep checking my local wine merchant. I haven't seen any negative pricing there.
Yeah,
but,
I don't think. Yeah, I doubt that's
springs eternal.
That's right. Yeah, so I think that look, a lot of uncertainty right now, obviously.
Well, I'll tell you what. I think that's probably not a bad place for us to wind this first chat up, and I'd love to come back and revisit it again over the next weeks and months as the picture unfolds. Because I think you're right. There's a lot of guessing, but we're heading down a path we've never been down before. It'll be
right. Yeah, it's impacted. I mean, I've not written as much as I thought I was going to write, because I think part of it is I don't want to contribute to a lot of the noise when I don't really know. I have no clue. I think like anyone else does, and I think like I said, my opinions probably change every day or weekly on this. So like last week, if we had this conversation last week, I would have said absolutely cash for clunkers, 100%. Now I'm saying I don't think so. So
the situation is changing so fast,
right.
Yeah, I think it's going to continue to do so.
Right. Well, this is fun.
It is
Neil,
fun. It's always great to talk to you. And
yes,
stay safe, stay well.
Yes, you too.
We'll revisit.
All right, great.
Thanks, Cliff. Signing off for Canadian Auto Dealer.